Hello and welcome to Marketing Global Edition with me, Jasmine Montgomery.
And me, Piers Geiler.
So, Piers Geiler, you and I were in a meeting the other day, and somebody asked us a really fascinating question, and we came out and we said we should do a podcast on it. So unfortunately, we can't say who it was because it's top secret and they would kill us. But it was one of the Middle East's leading holding companies talking about their branding. We were asked to come in and talk about their holding brand. And their CEO, who was a very clever man and head of a family business, said to us that conglomerate holding company brands, a master brand that owns lots of different things from, it could be from food to retail to fashion to steel to automotive to financial services to goodness knows what, right? He said to us that conglomerate brands are being discounted by investors. So, his question was, what was the point of investing in a holding company brand these days?
Yeah, exactly. And the whole reason we were there was to expressly talk about the holding brand and branding it.
Yes, it was a slightly odd moment. But nevertheless, his point was a really interesting one. So he believes that investors are discounting holding companies. And so we went away and did some research, and there does indeed appear to be a belief that companies are not always more than the sum of their parts. In fact, that the sum can be less than the total value of the parts. It is essentially an argument that individual businesses owned by conglomerates are valued lower than the pure play businesses with whom they compete in the same industry.
I know, in which way it makes very little sense, doesn't it? I mean, why should I, as an investor, feel that a conglomerate is worth less when bought together?
I guess putting it another way, are big holding companies actually worth less because they're too complex to love?
It could be. I mean, it's simple maths, isn't it, though? I mean, 2 and 2 makes 4, right? How can it suddenly make 3, to put it into simple language?
Yeah. It is one of those fascinating intersections between finance and brand, which is a space that you and I love, don't we? Because we love it when what we do isn't colouring in or picking a Pantone reference. Not that that's not important. But when it's like about building true brand equity and so on. So, I love this space. So when investors apply a conglomerate discount, they're saying essentially, we don't quite believe your story. We'd rather own the pieces than the whole. So we'd rather own just the car company or just the steel company or just the whatever.
Yeah, exactly. So today we're going to explore why that happens and whether branding can fix it. So should conglomerates double down on the individual brands within their portfolio or build a stronger master brand that explains the logic holding it all together?
Yeah, and I think to do that, we're going to look at some of the world's most famous group holding brands. Tata, Majid Al Futtaim, Unilever, Alphabet, Virgin, that have kind of tackled that exact question.
Okay, so let's start with the basics. In investment circles, a conglomerate discount means that the market values a diversified group at less than the sum of its parts. Yeah? And if all the subsidiaries were listed separately, together they'd be worth more than the parent.
Yeah, so the strange fact is, and apparently this is true, that it's uncommon for a conglomerate's business units to lead their peers in return on investment of invested capital or organic growth. So what that means, in other words, if a conglomerate owns a steel company, a food company, and a financial services company, each of those is unlikely to be as successful as a steel company on its own, a food company on its own, etc.
Okay, but some of that's because of underperformance at a business level, right?
Yeah, so apparently the reasons can be both emotional and structural, can be sort of brand and kind of, structural. So, since we are a podcast about marketing, we're going to leave aside the reasons of genuine business underperformance that might apply in some cases and focus on the more intangible part of valuation, the kind of brand proposition, which, hugely drives valuations.
Says us, but we work in branding, so why would anyone believe us?
Says McKinsey.
Okay, fine.
So basically, it's about the story you tell. So McKinsey actually, who've done a whole thing on this, actually talk about this. So they talk about the fact that brand is a huge contributor to this. So this isn't just us saying this, other third parties say that brand is a huge part of your valuation, right?
Yeah.
We know that, but it's nice to hear somebody else say it, you know. So I think that the thing is that investors like clarity, right? So they like one story, one business model, one P&L, and conglomerates kind of, by the way, it's such a horrible word, conglomerates, hilarious, horrible word, interesting subject. But conglomerates or holding companies kind of offer the opposite of one story, one business model. They have inherent complexity, kind of opacity, sometimes even kind of the whiff of empire building.
Yeah. Well, listen, McKinsey estimates the average discount, conglomerate discount, at around 10 to 15%, right? But in emerging markets or family-owned groups, it can be far higher, which is precisely where the branding tends to be least coherent, to be honest. So.
Yeah, I think it's the classic marketing problem, really, you know, just writ large across a Bloomberg terminal. If audiences don't understand who you are or what holds you together, they discount you, literally. They literally don't count on you.
Okay, so how do you fight that? Broadly, there are two strategies. Option one, go all in on the master brand, right? A single identity shared across everything. Think, I don't know, BMW, yeah? Option two, you double down on the individual brands and you let each business speak for itself. And you stop pretending there's this like grand unifying idea that's adding value to all the little bits.
Yeah, so in some ways you can think of it as a spectrum from kind of Apple to Unilever. You know, Apple on this side is kind of the ultimate master brand. So everything carries the same design language, the same minimalist aesthetic. It's even more than a conglomerate, it's a cult.
Yeah, okay. And whereas, you know, Unilever and P&G sit at the other end to Apple, right? Most of us don't buy Unilever. Well, you know, we buy Dove or Ben & Jerry's ice cream or Persil. The corporate name is pretty much invisible to consumers. It's visible really only to investors.
Yeah, and I think both models work, but for very different reasons. So Apple's brand coherence really adds to investor confidence, whereas in Unilever's case, the separation protects each brand's equity, but can make the parent story harder to tell.
Okay, so Jasmine, let's start with Apple, right? Technically, it is a conglomerate. Hardware, software, finance, entertainment, retail, yet nobody treats it like one.
It's so funny, isn't it? Because if you said, think of a conglomerate, think of a holding company, like nobody says Apple, but Apple really is the ultimate one. And I think what they do so cleverly is that everything feels like it springs from a single source. The design is consistent, the tone is restrained, the promise is simplicity, right? So the brand acts as a unifying philosophy. You know, it just works. And you're going to get that across everything.
Yeah, it does. And that's the lesson. You know, a master brand reduces perceived complexity. So for investors, Apple's valuation premium reflects belief that the whole ecosystem, from the phone to the TV to cloud, is stronger together.
Yeah, I mean, in a sense, Apple is kind of probably is the opposite of a conglomerate discount. It is essentially a conglomerate premium, if you like, where branding coherence really becomes a key financial asset and drives Apple's brand value hugely.
Absolutely. Okay, now on the opposite side is Unilever, right? They operate a house of brands model, and each brand is autonomous, targeted, often with its own social mission.
Yeah, and I think that freedom allows for some really sharp positioning. So, you know, I think it's interesting to kind of bring it home to people. I mean, you don't buy Unilever moisturizer, right? Or Unilever shampoo. You know, it allows them to be really targeted in what they do. So Dove's self-esteem story would sound really bizarre coming from the Unilever master brand. You know, Unilever, you know, moisturizer wouldn't have the same resonance that Dove does. But the trade-off is cost and complexity. So investors sometimes see a portfolio of unrelated brands with limited synergy and worry about it and don't understand it, you know.
Which is why Unilever has tried to tighten its story around brands with purpose. It's a softer, like, master narrative. You know, the common thread is ethics, really, but it's still a federation, not a family.
You and your love of brands with purpose, slipping that one in. That's true. So I think we've sort of defined, Unilever and Apple have kind of defined the ends of the spectrum. And people love to look at it in this very kind of binary way. But in the real world, I think the real truth is that most modern holding companies or conglomerates live somewhere in between these two extremes. And I think what works for most companies today is what we would call variable proximity, an architecture that allows for differing degrees of sort of elegant endorsement, letting sub-brands keep their individuality where appropriate, where they've perhaps acquired a brand that's got a lot of value, but showing the logic of shared ownership in some way through naming, through design, through something, you know?
Yeah, variable proximity. I love that. So it's, you know, it's less about stamping the parent logo everywhere, and it's more about creating a family resemblance. Okay, so shared design systems, typography, maybe even a line that says, you know, a member of the XYZ group.
Yeah, I think that the goal isn't uniformity, it's coherence, right? You know, if we think of it like an architecture, each building is unique, but all designed by the same hand. And I think that's when it works really, really well.
So here's a perfect example is Tata. So Tata, one of India's oldest conglomerates, they've got everything: steel, cars, IT, hotels, retail, even airlines, plural.
Yeah, I mean, it's the ultimate holding company, isn't it? So most of the businesses carry the Tata prefix: Tata Steel, Tata Motors, Tata Power. You know, the name signals trust and integrity. It's a really sort of a moral endorsement, I think, because the Tata family had done such a tremendous job of running that business, and you know, people like Ratan Tata had such extraordinary respect in India that, you know, that kind of moral authority, that personality, a bit like Richard Branson, you know, goes through everything. So I think few brands out there command the kind of instinctive respect that Tata does. So it gets away with putting its name on everything because it's not about flashy marketing. It's more about a century-long reputation for doing the right thing, you know, paying workers fairly, investing in communities, that kind of stuff, taking the long-term view when other people chase quick wins. And I think while some conglomerates feel quite faceless, Tata has, you know, really turned its kind of corporate name into a shorthand for trust, reliability, moral steadiness. It's almost a kind of civic brand in a country where business and nation building have often been intertwined. And so it's got some real equity in that name.
So it does brand it a lot of places, but not everywhere. Not everything is branded Tata. So Taj Hotels, for instance, within the group, operates its own sub-brands. So they've got Vivanta Hotels, they've got, love this, Ginger Hotels, they've got Air India, Air Asia, you know, because some sectors like hospitality or travel, air travel, need emotional storytelling that, quite frankly, Tata Steel isn't going to, or, you know, it's not going to bring as much there.
Yeah. But even when they do have something like, you know, Air India, which is very differently branded, they still bring that kind of Tata ethos. So in that terrible Air India crash recently, they were very honorable in the way that they looked after the families, and they sort of brought that Tata, you know, way of treating humans to the table, which is just so lovely. So, but definitely Tata uses variable proximity, strong endorsement where the heritage helps, and lighter where creativity or luxury brands kind of need that independence.
Yeah, it's a powerful way of ensuring risk management, really, isn't it? You know, close enough for reassurance, yet distant enough for some flexibility.
I think another great example of this, and we're looking for examples, of course, not just in the West as ever, you know, so another one that I love from the Middle East is Majid Al Futtaim. So it's really kind of, they do it really well. You have Majid Al Futtaim, one of the Gulf's most sophisticated branded houses. So most of their investments carry the Majid Al Futtaim name. You've got Majid Al Futtaim Properties, Majid Al Futtaim Retail, Majid Al Futtaim Entertainment, Communities, etc. But they do variable proximity so well, where some of the brands are really close in and others not so much.
Yeah, I mean, visually it's really strong. At the core
Yeah.
is the Majid Al Futtaim logo. They've got these like golden arches. It's very, very distinct. You see it across everything. So, but really, fundamentally, if you look across the group, it's a system identity that holds it together. You see sub-brands can take on the symbol, these golden arches, but adapt then that symbol into their own colour palette. So that consistency is the strategy. It signals competence, modernity, and cross-sector synergy.
Yeah, so most of the brands they have built, like Mall of Dubai, Mall of Oman, city centre malls in lots of places, actually have the arches, the M, you know. But they did something really clever with Carrefour. So they actually own all the Carrefours in the Middle East, and they have a license to use the brand from Carrefour globally. But what they've done is they've morphed the Carrefour logo into their arches symbol, but kept the Carrefour colours. So to the eye of anyone familiar with Carrefour in the West, you almost don't notice that the logo has changed and become the Majid Al Futtaim logo, because the colour vibes just fit the Carrefour global brand. But when you see a map of all of Majid Al Futtaim's brands, it fits right in with everything else. So it's really quite clever.
That's really good. Actually, yeah, it's very clever, that. Okay, but anyway, even the mighty Majid Al Futtaim doesn't change certain brands that come into its orbit, does it?
Yeah, I mean, of course not. You know, they have a license to distribute lots of brands, and you know, things like Lululemon, Abercrombie and Fitch, Lego, Crate and Barrel, Alessi, etc. So obviously they're not going to change those names. So, or things like, you know, Sheraton, Weston, etc. But when Majid Al Futtaim create a brand that they own, they're very clear to brand it with a clear visual link back to the mother brand.
Yeah, right. So where Tata relies on heritage to connect its brands, Majid Al Futtaim, I have to say that, relies on design discipline. Both are endorsement models, one moral and the other aesthetic.
Yes, and then of course there's Virgin, which breaks every rule and somehow it still works. So it's got a sort of brand licensing ecosystem: Virgin Atlantic, Virgin Money, Virgin Voyages, Virgin Active, all independently run, all paying to use the name. Very clever.
Yeah, exactly. It's how they do it. Virgin Management in London acts as the master brand custodian. They sit there and they do approve ventures, they audit the tone of voice of the communications, and they also charge a small percentage of revenue for the privilege of that lovely red script logo.
And of course, in this case, what keeps it coherent is personality. You know, Virgin is totally synonymous with Richard Branson's irreverence and his humanity that run through everything. He's very, very naughty, Piers. I don't know if you know, there are some hilarious stories about the way in which he has brought some of his brands to life. I mean, when Virgin Atlantic brought out double beds in first class, you know, British Airways brought out double beds in their first class cabins, and they did a very sort of poker faced, you know, now you can beat jet lag with this, you know, extra space. And Virgin hopped into one of the beds with a couple of his Virgin Atlantic stewardesses and, you know, did the PR launch from there. So, I mean, he is a naughty fellow, but he has so much character, so much, you know, and personality, iconoclasm. He breaks rules. He brings all of that to the table, and that is just throughout the brand. You know, there are so few brands that can pull that off, you know.
Yeah, I mean, yeah, Virgin's I love Richard Branson, I love the Virgin brand. It's fantastic. But when you put the brand across everything in your group, if you like, there are pros and cons to that, obviously. You know, there are the pros, that you get all the great stuff, but also there are the cons. So when, as an example, Virgin Orbit collapsed, the headlines weren't saying small aerospace startup fails, they say Virgin fails. So that's the reputational risk of that sort of full-on extreme endorsement where everything is branded.
Yeah, and I think, you know, some brands have really consciously decided to do the opposite, you know, to really sort of have the master brand step back. And I think Alphabet, of course, you know, did the opposite of that sort of thing. So it really kind of debranded Google, where, you know, Google remains the search engine, but the holding company decided that it exists for something completely different, not to help people find their nearest, you know, ice cream shop, but that it exists mainly for governance and investor transparency.
Exactly, and fascinating, really, because what it did do is it protected the Google brand from moonshots like Waymo or Calico, while giving investors visibility into the cash cows versus the experiment. So it sort of managed the portfolio really well.
Yeah, and I think in that sense, Alphabet turned branding into a governance tool. You know, it was a separation designed to reduce the conglomerate discount, certainly.
Yeah. Okay, well, look, if we look at this from a more global perspective, there's another dynamic at play. Because most Middle Eastern and Asian conglomerates, and there are, you know, Majid Al Futtaim, Altea, Al-Ghanim, Tata, Salim Group in Indonesia, CP Group, Thailand, you know, wow. They didn't start from strategy decks, is the point. They started from families. They often started from one ambitious founder, several optimistic diversifications, and decades later, boom, you know, an empire.
Yeah, and I think, you know, that's a whole other story in many ways. I think, you know, as you say, it's not strategic. You know, it's opportunistic, and it creates a paradox. So founder stories in some ways make the coherence emotionally easy. You know, you've got built-in heritage and trust, perhaps like Tata, but strategically, it can really be very messy. The unifying thread is often the person, not the purpose in the portfolio.
Yeah, exactly. So if they're lucky, investors love the warmth, but they worry about the governance. But personality coherence doesn't always translate into business logic.
Yeah, and I think the trick is to turn the founder's character into a capability narrative. You know, we build lifestyle ecosystems, or we engineer trust. You know, that's kind of what Tata and Majid Al Futtaim have done so well. You know, one leans on moral credibility, the other, I think, on kind of design coherence and also, you know, brilliance in how to do business.
Yeah, you mentioned design earlier, and I think this is sort of the under-discussed superpower here when it comes to conglomerates. You know, when you can't simplify your portfolio, you can at least harmonize its aesthetic.
Yeah, I mean, I really so think that is the untold story here so much of the time. So many of these conglomerate companies, when I look at them, I just think, you look a mess, my friend. And, you know, I think that I want to do a podcast one day on like the subliminal power of design. Design can do so much that we don't even give it credit for, that we don't know it's doing to us. And a consistent design system is a language that investors can read. If we asked a bunch of investors, if we went to the London Stock Exchange right now and asked a bunch of, and I've done this because we rebranded the London Stock Exchange many years ago, their main market. If I went and asked a bunch of, you know, guys at the London Stock Exchange, how much do you notice how well designed a group's portfolio of brands is, they wouldn't be able to articulate it. They would say, oh, no, we just look at the financials. But it, on a subliminal level, it works. You know, if it looks like there's a cohesive, kind of coherent, organizing set of principles behind it, it influences them. And I think things like typography, color, grid, even photographic style, but the logos, the name, the nomenclature, the whole system can really signal discipline and competence, even if it's not there.
Exactly. So the problem arises because, you know, a board will call in a consultancy and the strategists go in.
Yeah.
Right. It's the strategists, and it's all decks and slides, but it's not solutions. It's not real world. It's not the reality of consumers looking about to understand and navigate the offer. And that's why strategy and design should work together, which, you know,
Yeah.
I think we do. But anyway, but I'm not trying to sell us. You know, I think that's really important. You know, so you know, it avoids the mess of mismatched logos that say sprawl. And when you bring in strategy and design together, you get a cohesive system that says orchestrated.
And I think what happens is that every now and then, you know, it's sort of cyclical. A company will do it. They will rationalize their portfolio. They'll do some portfolio brand architecture rationalization. Somebody comes in and creates a design system, and it's all great. And then, you know, for the next few years, each different department or silo comes to the CEO and says, no. I have this brand over here that requires a completely different logo. I'm very sorry, it cannot possibly fit into the group for the following reasons. And they convince, you know, the CEO, well, okay, fine. You know, you think that it's a key driver of demand in your market. We wouldn't make money if we didn't have a completely different logo. And that conversation gets played out 50 times across the business. And then 5 years down the road, you know, you have this thing that looks like a dog's dinner. And I think this is where branding really is not just cosmetic, but structural. You know, for conglomerates that can't be simple operationally, design consistency creates the illusion of simplicity, and that is a powerful thing.
All right, let's answer our own question then, Jasmine. Okay, if investors are discounting holding companies, what should they do about it?
Yeah, so what can these brand owners do? Well, you know, as we've said, option one is brand more strongly at the lower level. So, I mean, there is an argument perhaps to let each company brand build its own story, its own equity, its own investor following.
Yeah, okay. And option two is build a stronger master narrative. Explain, you know, what brings it all together.
But I think that more often than not, it's not about that dichotomy. It's not about be at one end of the spectrum or the other. I think that actually most of the time it's about that elegant endorsement model that does complexity but makes it look like simplicity. And that, you know, most of the time there's a hybrid in the middle, and the parent brand needs to make a coherent promise with kind of values, design, culture, etc., while the sub-brands deliver it, in their own ways where they need to make money.
Exactly. So elegant endorsement again. Map your portfolio by proximity. Which brands need to sit close to the master for credibility, and which should orbit freely to avoid the clutter.
And then codify that proximity in your design system so that the visual hierarchy becomes your governance chart, really, and express it to the world beautifully.
Exactly. Oh, great. Well, let's think about the investors. So from an investor side, the key is transparency. Conglomerates get discounted because people just can't see the logic, right? So the branding's job is to make the logic visible.
Yeah, and I think, it is about that storytelling, isn't it? It's about, why do you have all of these businesses? Is it just purely opportunistic? And maybe it is, and then it shouldn't be about spin, it's about structure. If your businesses share data, they share culture, they share a customer base, show that clearly. If they don't pretend they do, separate them gracefully.
Yeah, I mean, investors forgive complexity if they believe the complexity is managed. They punish it when it looks like chaos, though.
Yeah, so, quick fire, looking back at the examples we've talked about, we've had Tata, which was kind of coherence through heritage, Majid Al Futtaim, coherence through design, Apple, coherence through philosophy, Unilever, coherence through purpose, you talked about, Virgin, coherence through sheer charisma and personality, and Alphabet, coherence through governance. So there are quite a lot of different ways to do it.
Exactly. 6 very different ways of saying give investors a reason to believe the whole is greater than the sum of the parts.
Yeah, so to sort of end where we began, yes, investors do often discount conglomerates, but it's not inevitable. And the discount really is a storytelling gap, and it's a, design of your portfolio gap, which branding can help with.
Yeah, branding can close that gap either by elevating the master brand in something meaningful, moral, aesthetic, philosophical, if anyone's listening, or by freeing the subsidiaries to shine with clarity themselves.
Yeah, and maybe, just maybe, the best test of a conglomerate's health isn't its share price, but whether you could describe what holds it all together in a single sentence.
Exactly, and if you can't, the market probably won't either.
Absolutely. There you go. That's all for this episode of Marketing Global Edition. If you enjoyed it, do think about following us on LinkedIn and subscribe wherever you get your podcasts.
All right. Thanks very much.
Lovely. See you next time. Thanks. Bye.
Marketing Global Edition is sponsored by 𝐒𝐙𝐧𝐧𝐸, the ad generator for small businesses that serves you effective and affordable ads in seconds. And by 7 Brands, the international advertising and branding agency that has worked with clients around the world from Coca-Cola to Facebook.